Welcome to today's class. We're going to be talking about Japanese candlesticks. The objectives of this class today is that at the end of the class you should know what the candlestick structures are. You should also be able to identify basic candlestick patterns. You should also be able to identify the two important patterns of a candlestick. These are the pin bars and the engulfing patterns. At the end of this module, I'll be also sharing some important things you need to note about candlestick patterns. Let's dive into the course. Understanding the candlesticks. Candlesticks are the building blocks for the price chart. They show basic information about price movement within a period. Now, what we need to understand is that the price chart is basically made of these Japanese candlesticks. So it is very important for every trader to understand the structure of a candlestick. Candlesticks show basic information about price movement within a period. This period is what we refer to as time frames. Example of time frames are 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hours, daily, weekly and monthly time frames. Now what I mean by this is, take for an example, we have a market that opens at 12 p.m. Now, we're looking at a period of 1 hour, that is between 12 p.m. and 1 p.m. We want to know the price movement between the hours of 12 p.m. and 1 p.m. The candlestick is going to show you when the price opens, the highest price that was attained within this 1 hour, where the price closed, where the market closed, and the lowest price that was attained within the 1 hour. So when we say 5 minutes candlestick or 1 hour candlestick, it refers to the basic price movement measured within the 5 minutes period or the 1 hour period respectively. Structure of the candlesticks. The price of a pair is never static. It is dynamic over a period. In order to understand what has happened within a period, traders use the Japanese candlestick. Like I mentioned before, the price of any trading pair, when I mean a pair, I mean any trading instrument, including the metals like gold, commodities, indices, FX, any tradable instrument. The price is never static, it's always dynamic. You can have a price move from we can have a pair move from one price to another within a minute, within 5 minutes, within 1 hour. Now, to measure this price movement within a period, we use the candlesticks. The structure of a candlestick clearly shows the open price, the close price, the highest and the lowest price a pair reached within a period. Just like I mentioned before, the candlestick will show you what price a pair opened at. It will also show you the price which a pair closed at. It will show you the highs and the lows. That is the highest price of the period and the lowest price of the period. This is clearly shown on this diagram. Now let's look at the diagram closely. You'll find out that we have a candlestick has basically the real body, the lower shadow and the upper shadow. Now within this real body, the upper shadow and the lower shadow, it tells us the open price, that is the price at which the market opened within the period. It also shows the close price, which is the price which the pair closed within the period. It shows the low and the high. The low is the lowest price which this pair touched within the period, and the high is the highest price which the pair touched within the period. On the right side, you will also see another type of candlestick, but this time around the open and the close price, the close price is lower than the open price. We'll discuss that in the subsequent slide. The bearish and the bullish candles. Based on the open and the close price of each candle, a candle can be classified as a bearish or a bullish candle. The bearish candle. The bearish candle, this is the candle that opens on a higher price and closes on a much lower price. Now, looking at this diagram, you find out that the open price is higher than the close price. What this means is that market opened at a price. By the time the period was over, we had a depreciation from the open price to the close price, meaning there was a negative movement of price. Now, once you have a negative movement of price, the candlesticks that form is called the bearish candle. The bullish candlestick. This is a candlestick that opens on a lower price and closes on a higher price. Once there is an appreciation in price, what I mean by this is when the close price is higher than the open price, the type of candlestick that forms is the bullish candlestick. Candlestick patterns. Now, it is very important to understand that application of candlesticks lies on the type of patterns that are formed as these candlesticks show up on the chart. We have about 8 main patterns of candlesticks, but in this course we'll be discussing 2 which are the most prominent. Now, the reason we are discussing these 2 is that whenever these 2 types of patterns show up, there is a high probability that price is going to turn, or price is going to continue in the direction it was going before. The pin bars. The pin bars are reversal single candlestick patterns that show exhaustion during a trend. This is to say that the pin bars give indication that a trend is about to change. A bullish pin bar shows that a downward trend is about to change to an upward trend, while a bearish pin bar shows that an upward trend is about to change to a downward trend. Now, the pin bar is a single candlestick bar. What it means is that, let's assume that we're in an upward trend. If a pin bar, this time around a bullish pin bar appears, the trader is alerted and he knows that something is about to happen. There's about to be a change in direction. So what happens at that point is you look at the chart closely and bring out your entry criteria before you make an entry, or you make a market entry. This applies to the bearish pin bar also. The diagram below shows clearly how these pin bars are formed. The pin bar is made up of a very small real body with a big wick and a small nose. The wick is usually about 2 times the real body. You can have a bearish pin bar and a bullish pin bar, as we explained before. the engulfing patterns. The engulfing patterns are also reversal patterns like the pin bar. They show exhaustion during a trend. This is to say that the engulfing patterns give indication that a trend is about to change. A bullish engulfing pattern shows that a downward trend is about to change to an upward trend. A bearish engulfing pattern shows that an upward trend is about to change to a downward trend. Now, let me explain briefly the structure of a bearish engulfing pattern. Now, a bearish engulfing pattern is a double candlestick pattern where first you have a bullish candle and followed by a bearish engulfing, a long bearish engulfing candle. Now, for a pattern to qualify as a bearish engulfing candle, the following needs to happen. The bearish candle needs to open at or above the previous candle's close, as we can see on the chart. The length of the bearish candle engulfs the previous green candle, that is the previous bullish candle. The bearish candle closes below the previous candle's open. This is the previous candle's open. This is the bearish candle's close. So the close should be below the previous candle's open. The bullish engulfing pattern. The bullish engulfing pattern is just an opposite of the bearish engulfing pattern. Before a pattern qualifies as a bullish engulfing pattern, the bullish candle must open at or lower than the previous candle's close, just as we have here. The length of the bullish candle engulfs the previous red candle. This is the previous red candle, which is a bearish candle. Then the bullish engulfing candle must engulf the previous red candle. Thirdly, the bullish candle closes above the previous candle's open. The previous candle's open is this, while the close of the bullish candle is this. Important things to note about a candlestick pattern. Over the years, based on my experience, I've found out that there are things you need to note about a candlestick pattern to be profitable as a trader. Some of these things are: candlestick patterns are not fail-proof. They only indicate or suggest that a trend may change soon. Now, what this means is that it's not every time you see a candlestick pattern, whether a bullish engulfing or a pin bar, that a reversal will occur. So you need to wait for extra confirmations. We are going to be talking about how to look out for extra confirmations in the subsequent classes. The candlestick pattern that form on a higher time frame are more reliable. That is to say that the higher the time frame, the more reliable the candlestick patterns. Now, if you have a candlestick form on a 15 minutes time frame and you have a candlestick pattern form on a daily time frame, there is a high chance that reversal will occur on the daily time frame than it is going to occur on the 15 minutes time frame. So what this means is that you stand a higher chance of being right when you look at candlesticks from a higher time frame perspective. When a candlestick forms on a higher time frame. Most times, if you check on the lower time frame, you will notice that a chart pattern has also formed. Now, what this means is that if you go to a daily time frame and you have a bullish engulfing pattern, when you scale down to 15 minutes or 1 hour, you're likely going to find out that you have a chart pattern that has formed, maybe an inverse head and shoulder or a flag pattern. But you will notice that the bullish engulfing that formed on a daily is as a result of a chart pattern that has formed on the 15 minutes, 30 minutes or the 1 hour. We'll look at chart patterns in the subsequent class. It is best to look out for candlestick patterns around support and resistance zones, demand and supply zones, Fibonacci retracement zones. Now, a lot of traders go about looking for candlesticks all over the chart. This will keep you restless as a trader. What you should be looking at is look for candlesticks at points of interest. And these points of interest are support and resistance zones, demand and supply zones, and Fibonacci retracement zones. Note, we will discuss support and resistance, demand and supply, and Fibonacci retracement in the subsequent class. Thank you for attending this class. I will see you in the next class.